Crypto 2026, bull trap or the beginning of a new supercycle. The market doesn't trap the uninformed, it traps the certain. If you are already convinced that 2026 will be the next crypto supercycle, you are standing exactly where bull traps begin. Reality shock. Why this time is different always sounds intelligent. Every cycle has a moment when the argument feels airtight. 2017. Blockchain adoption is inevitable. 2021. Institutions have arrived. 2024 to 2025. ETFs approved. Halving complete. Regulation clearer. Macro pivot ahead. The story sounds stronger than ever, and that is precisely the danger. Markets peak not when narratives are weak, but when they feel undeniable. Right now, the dominant belief is Bitcoin supply is fixed, institutional demand is structural, liquidity will return, crypto is integrated into global finance. Each statement contains truth, but markets are not moved by truth alone. They're moved by positioning. When everyone aligns in the same direction, risk becomes invisible, and invisible risk is the most expensive kind. Framework, model, the structural cycle lens. To evaluate 2026, we need a disciplined lens. Not emotion, not prediction, structure. Here is the four-layer model I use to distinguish a bull trap from a supercycle. Liquidity regime, leverage structure, narrative temperature, capital duration. Let's break this down. 1. Phrase, liquidity regime. Price follows liquidity, not halving events. Crypto does not move because of events. It moves because of liquidity. Halving narratives are visible. Liquidity expansion is invisible and far more powerful. Ask yourself, are global financial conditions easing sustainably? Are real yields declining structurally? Is risk appetite broad-based across asset classes? If liquidity expansion is shallow or temporary, rallies lack foundation. Bull traps are built on temporary liquidity relief. Supercycles are built on structural liquidity expansion. Price action without liquidity is momentum. Momentum without liquidity is unstable. 2. Leverage structure. Rallies built on borrowed money collapse faster. Leverage amplifies cycles. In 2021, perpetual futures funding rates stayed overheated for months. Open interest ballooned. Retail margin participation exploded. That wasn't strength. It was fragility disguised as conviction. In a true supercycle, you will see spot accumulation leading, derivatives growth controlled, funding rates mean reverting. In a bull trap, you will see funding persistently elevated, meme speculation accelerating, leverage expansion outpacing spot demand. Leverage does not create trends. It accelerates reversals. The difference between a breakout and a trap often lies in the leverage ratio. Narratives follow a predictable arc. First, they are ridiculed, then ignored, debated, accepted, and finally weaponized. Supercycles begin when narratives are ignored, while bull traps often happen when narratives are weaponized by the market or prominent voices. Currently, dominant narratives in crypto include Bitcoin as digital gold, ETFs as permanent demand engines, AI and blockchain convergence, and tokenized real-world assets. None of these core ideas are irrational, but they are no longer early or contrarian. When YouTube thumbnails scream inevitable, when timelines become echo chambers, and when dissent feels outdated or dismissed, narrative temperature is high. High narrative temperature increases fragility, not because the thesis is wrong, but because positioning is crowded. Who's buying and how long can they hold? This is the layer most investors ignore. Not all capital is equal. Short-term capital reacts to volatility. Long-duration capital absorbs it. Determining capital duration is essential to understanding risk. Ask, are institutions allocating with multi-year mandates or rotating tactically based on macro signals? Are treasuries accumulating or just trading? If capital duration is short, even small macro shocks can unwind positioning rapidly. Bull traps rely on fragile capital. Supercycles rely on patient capital. You cannot see duration on a price chart, but you can infer it from investors' behavior and how they respond to different market events or shocks. At the surface level, bull traps and supercycles look identical. They both start with aggressive market breakouts, expanding participation, and growing optimism. But the difference lies underneath the surface. Bull trap equals momentum plus fragile liquidity. Supercycle equals liquidity plus structural capital. Momentum can last months. Structure can last years. Most investors mistake duration for permanence, leading to misinterpretations. Crypto in 2026 is not crypto in 2017. It is now partially embedded in traditional finance systems. This integration changes the mechanics of volatility, but does not eliminate them altogether. ETF flows can amplify the upside, but they can also accelerate downside moves. Institutional integration reduces chaos at market peaks, but increases speed during deleveraging. Future unwinds may look orderly, until they aren't. Remove the chart. Close your eyes. Imagine there is no price data, no green candles, no headlines. Would you still believe a super cycle is forming? If your conviction depends on price momentum, you are reacting, not analyzing. Professionals evaluate liquidity, leverage, capital behavior, and macro structure. Price only confirms structure, it does not define it. Pause here, because this is where most investors lose discipline. They let momentum replace analysis. After a prolonged bear market, investors don't become greedy first. They become relieved. Relief lowers skepticism. Relief increases position size. Relief turns maybe into obviously. Bull traps are built on relief. Supercycles are built on disbelief. If 2026 feels obvious, be cautious. If 2026 feels uncomfortable, pay attention. Markets reward discomfort. They punish certainty. I do not need to predict 2026, I need to survive it. So I ask 3 questions. If this is a bull trap, what is my maximum damage? If this is a supercycle, how much upside do I capture? Can I remain rational through a 50% drawdown? If the answer to number 3 is no, my position is too large. The market does not eliminate investors who are wrong. It eliminates investors who are overexposed. In part 2, we will go deeper. The psychological trigger that confirms bull traps, the asymmetry equation for 2026, the one irreversible insight about crypto cycles, and the final operational stance without prediction. For now, understand this. The debate is not about direction. It is about structure. And structure is invisible to those who only watch price. Pause there, because 2026 will not test your intelligence. It will test your sizing. Bull traps begin when fear quietly turns into confidence. A bull trap is not a technical pattern. It is a psychological transition. It happens when fear fades, caution softens, position size expands. The most dangerous moment in any cycle is not euphoria. It is comfort. When volatility compresses, when dips are bought automatically, when investors stop asking, "What if I'm wrong?" That is when the trap is set. Super cycles begin in skepticism. Bull traps begin in comfort. If 2026 opens with aggressive rallies and fast dip recoveries, ask yourself, are people still skeptical, or are they relaxed? Relaxation in a high volatility asset class is rarely sustainable. Relaxation in a high volatility asset class is rarely sustainable. Many believe this cycle is different because crypto is now integrated. Spot ETFs, institutional custody, regulatory clarity, corporate treasuries. They interpret integration as maturity. But integration does not remove cyclicality. It modifies liquidity pathways. When crypto was retail-dominated, tops were loud and irrational. In an ETF-dominated environment, tops can be quiet. They can look institutional, orderly, rational. That is more dangerous because people lower their guard. If macro conditions shift unexpectedly, liquidity tightens, volatility spikes, risk models trigger. Institutions don't argue with narratives. They rebalance, mechanically, and mechanical selling has no emotions. The ETF era doesn't prevent bull traps, it compresses them. VIF, the 2026 Asymmetry Map. Think in scenarios, not headlines. Here is how a veteran frames 2026, not as a prediction, as a decision tree. Scenario 1, true supercycle. Conditions required, sustained global liquidity expansion, risk premium compression across asset classes, spot demand leading derivatives, institutional holding periods extending, on-chain usage rising independently of price. If these align, upside can compound, but even then, volatility will remain violent. Supercycles are not smooth, they are upward with brutality. Scenario 2, bull trap. Conditions required, temporary liquidity relief, narrative explosion, AI, RWA, tokenization hype, funding rates persistently overheated, retail leverage expansion, momentum strategies dominating flows. This structure can produce plus 50%, plus 80%, plus 120%, and then erase it in months. The trap is not the rally, the trap is believing the rally proves permanence. Where most investors fail. They misjudge time horizon. Retail investors think in price targets. Professionals think in liquidity cycles. If you are positioned for a 24-month thesis, but liquidity is fragile in the next 6 months, you are mismatched. And mismatched time horizons create forced decisions. Forced decisions destroy capital. The market does not punish wrong direction, it punishes wrong duration. The position sizing truth. Your exposure defines your emotional stability. Here is the irreversible truth. If a 40% drawdown destabilizes you emotionally, your position is too large. It doesn't matter how bullish the thesis is. It doesn't matter how strong the narrative feels. Crypto volatility is structural. If you cannot tolerate it, you cannot hold through it. And if you cannot hold through it, you cannot benefit from upside convexity. Most people believe conviction creates returns. In reality, conviction plus oversizing equals forced liquidation. The for 2026 is not, will crypto go higher? It is, can I hold my allocation if it drops 50% in the middle of the rally? Because that has happened before, and it will happen again. The liquidity tell. Here is a subtle but critical tell for 2026. Watch what happens after the first major pullback. If liquidity is real, pullbacks are absorbed gradually, volatility contracts, volume declines on drops. If liquidity is fragile, pullbacks accelerate, derivatives cascade, funding flips violently. The first serious correction of 2026 will reveal the truth, not the first breakout. Breakouts attract attention, corrections reveal structure. Pause here. Imagine two parallel futures. In one, crypto enters a true supercycle. In the other, it was a bull trap. In both futures, you behave identically. You size for volatility. You avoid leverage. You rebalance into strength. You add on structural weakness. If your strategy must change drastically based on prediction, you are speculating. If your structure survives both paths, you are investing. Let that sit, because the market does not reward emotional alignment. It rewards structural alignment. Here is the insight you cannot unlearn. It doesn't matter whether 2026 is bullish. It matters whether your system is anti-fragile. Bull traps destroy overconfidence. Supercycles destabilize greed. Both environments punish poor structure. If you build defined allocation limits, liquidity monitoring rules, deleveraging thresholds, rebalancing discipline, you convert uncertainty into controlled exposure. The investor who survives cycles compounds. The investor who tries to win cycles resets. Crypto is not a game of prediction. It is a game of endurance. So, is 2026 a bull trap or a new supercycle? It is neither until liquidity confirms it, and by the time it is obvious, most capital will already be misallocated. The only rational stance today is conditional participation. Participate, but assume volatility. Allocate, but assume drawdowns. Engage, but assume uncertainty. Because the market does not reward those who need to be right. It rewards those who remain solvent. And in crypto, solvency is strategy. Silence the noise. Watch liquidity. Control size. The rest will reveal itself. No prediction required.